Disaster, where we blow apart the stock market and put it back together so that it makes a little bit more sense for you. I'm Forbes Markets editor John Dobis. Well, we're talking about this gentleman right here today, the upstart politician in Greece, the 37-year-old Alexis Tsipras, leader of the far left Syriza party, has not gone along and agreed to form a new government. He's saying we're not going to be a part of it. Greece will have no government until it elects a new slate of legislators at a time yet to be determined. But there's open talk about Greece actually leaving the euro. Credible talk. But the truth is that I think the Greeks need the euro more than Europe needs the Greeks. Although both would be hurt, at least in the short term, by the separation. And of course, the London whale over there, he's been making news and more splashes, taking some casualties down with his trading, losing $2 billion on a CDS trade. This gentle lady right here, Ina Drew, or Ina been a little more careful, I think I might call her, was in charge of monitoring risk for the chief investment office at the bank. She's now out and taking a retirement. And Jamie will be probably making some more moves as well. JP stock, if you thought it was low on Friday after revelation of the big losses in London, it got a little bit cheaper for you on Monday, down 3.1%, below the 200-day moving average. How low can you go, JPM? And all the other bank stocks too, thinking that this is going to be kind of like getting caught and making your parents or making some rule-making body, aka the U.S. Congress and the SEC, more stringent on your activities. In fact, I was having a discussion here with editor Matt Schifrin about the activities of banks, and he thinks that investment banking and deposit banking should be two separate things like they were under Glass-Steagall. But the Gramm-Leach-Bliley Act, 1998, undid Glass-Steagall. Do you think we need investment banks separate from deposit banks? Possibly, but we'd have a different kind of economy. In any case, it looks like harsher regulations are coming down on the banks because of the political lack of cover created by what's going on at JP Morgan. Here's the S&P 500 index. You got to ask yourself, is this sucker rolling over or is it coiling up for a big rebound? These are the stochastics down here. When you get below 20, we're at 13.22. You are oversold, due for a bounce. But then again, tanking markets cannot stay oversold for quite some time. But look at the action here. We've been slipping, and I'd say it's coiling, but also rolling over at the same time. If you believe in Dow Theory looks at the Dow Jones Industrial Average and the Dow Jones Transportation Average. When both are hitting significant new highs, the primary trend of the market is up. You can go to sleep, you can crack open the first of a six-pack, you can do whatever you want to do, and the market's going to go higher. But like we had in February here, this is the Dow Jones Transportation Average in purple. When it slipped and the Dow Jones Industrials went on to make new highs, that meant the market was suspect. And here we are now living in the aftermath of the suspect market. Just how suspect, we'll see. Do pay attention when these things happen, because look what happened here in late 2007, right before the crash in 08. You had the transports tumbling as the industrials rose to new highs, which presaged great trouble a little bit later, but great trouble in the future. How low can you go? That guy got really low. He's doing the old butt walk kind of a thing, you know, where you don't have your legs working for you. But what's also going really low besides that guy playing limbo are yields on U.S. paper. Bonds, bills, and notes, baby. 10-year note, we're talking about 1.78%. A little bit of perspective for you here. This is the 3-year chart. I'm sorry, yeah, that's a 3-year chart right there. We were a little bit lower in October, but boy, just when you think that bond yields can't go any lower, they do it. So this is telling you that bond investors, bond traders see slow growth, see really not a peppy economy down the road. So don't bet too much against bonds falling. In fact, if you want to ride the bonds, TLT's been your horse. Of course, people have called it out of the race for quite some time, but the TLT gets you access to 20+ year maturity bonds of the U.S. government. Intel, what could you do with low rates? You could borrow and you could buy stocks that have a dividend yield. Intel pays 3%. I have a sliver of it, a wafer thin, but it's kicking out a 3% yield. You can go for the reliable power companies like Duke Energy. Duke, big favorite there, 4.6%. Tons of other ones, Kraft, whole bunch of them. I don't want to sit here all day and bore you with them, but you can go find them. Happy Zuck Day. Mark Zuckerberg turns 28 ripe years old today. On Friday, he'll be unwrapping his presents, probably about $2.6 billion of the $11.8 billion raised by Facebook. Should you be partying with Zuckerberg? Should you step into the breach and fork over some of your hard-earned cash for some FB? Well, take a look at what their valuation might be. I know this may not matter because people will be caught up in the frenzy, but if you want to think about it analytically, we've gone over this before. $3.7 billion in revenue in 2011 for Facebook, according to their S1. Market cap, if all goes well, about $98 billion. That gives you a price to sales ratio 26.5. Google, our friend Google, which went public in 2004, has a 4.9% price to sales ratio. So you're talking about 5 and change times more precious on a price to sales basis. And earnings, similar story, comparing Facebook to Google. So tread carefully, watch those industrials and the transports to see when this market will be turning around. It looks like it's ready to snap back.